It's Christian Jane Kongstedt, and this is my Q1 2025 quarterly update on how my portfolio has been performing on eToro. I'm also known as CPH Equities on eToro, and you can follow and copy me by going to eToro and searching for CPH Equities. And today I'm going to speak about, first of all, my performance over the last year and also over the last 8 years. I'm going to speak about how the portfolio is set up at this point. I'm going to speak about 2024, what went well and what went less well, and also what I have changed for 2025. I'm also going to speak about if stocks in general are too highly valued or how we should perceive the current development and as opposed to the fundamentals in the stock market. So I think that's going to be an interesting discussion, and you're welcome to ask questions in the in the box on eToro. You can when I post this, you can ask me questions, and I'm going to get back to you as soon as possible with the answers. So first of all, I'm not going to make a big presentation of myself because many of you probably have seen my presentations before. But if you want to know more about me, then please go to YouTube and search for CPH Equities, and you can see a video where I explain a little bit about who I am and what my strategy for trading the stock markets, the financial markets is. Overall, on eToro, I've been investing and trading for 8 years now. I have double-digit returns for 7 years out of 8. My average return, the annualized return, is around 20% over this period. And the total over this period, if you look at the returns, you will see that I have returns of 273.9% versus 148% for the S&P 500 in the same period. And all years except for one has been double-digit returns. And I have a quite ambitious plan that I want to take my portfolio from the current amount, which is $122,000 to $1 million. And I've estimated this is going to take me around 14 years, actually in this moment, a little bit less than 14 years. And this is the target I have set. And this means that over time, I want to keep almost the same performance as I've been having historically. So I want to perform better than the S&P 500 and have an average annualized return of 16.5. And historically, I've had around 20%. So if I'm able to do that, then I'm going to reach my target in August 2038, and then I can retire at this point and have $1 million in cash. But maybe, and some people have asked me about this, perhaps at this point, I'm just going to keep on investing because I'm not going to be at the retirement age at that point quite yet. So I will probably keep investing for a while on eToro, even beyond that. So to understand my portfolio, for those of you that have seen it before, you may know this story. I have a core of the portfolio, and the core is quite large. It's focused on tech and AI, and you will see some of the companies here are some of the companies that have been driving and defining the AI revolution. And those companies presently constitute around 46% of the portfolio. So it's quite a large share of the portfolio at this point. You can see my top positions here. So except from those tech AI stocks, I also have some exposure to some of the weight loss drug companies like Novo and Eli Lilly. I have initiated a position long the US dollar. And also I have a position in Bitcoin between my top 10 position, but the Bitcoin position is only at this point about 3.7% of the portfolio. So I have a heavy emphasis on technology and also to some extent financial services and healthcare. And my portfolio overall is split in three. So I have this core of the portfolio, which is almost like 50% of the portfolio. Then I have a smaller part of the portfolio, which I focus more on momentum picks, which is shorter term investments or trades. And I have also a part of the portfolio which is value picks. And the general idea about having like three elements in your portfolio is that if one of those areas perform less well, then the diversification will allow for good performance even in these cases. So let's say the core of the portfolio do not perform so well for part of a period of time, then in these times, there's a chance that some of the other parts of the portfolio would perform well. This means that it's not a very concentrated portfolio. I could go all in on AI, and that's certainly tempting to do these days. But to have a diversification, I think, is a wise thing, because when markets turn around and when AI stocks and tech stocks at some point don't perform so well, and this does happen in periods. We saw it in 2022. Then it's important to have other parts of the portfolio that can drive the returns during this period. This also means that in some periods, I may not get the returns that I would have gotten if I've gone all in on like tech and AI. But I value the diversification quite high, and also the protection that it gives me during times of the market when the market performs less well. So I think that's quite important to have not only this element, the tech element in your portfolio. And I saw during 2022, you saw a lot of people going all in on tech and going all in on like cryptocurrencies and so on, losing 80% of the value or 50% of the value of their portfolio. And this is something that I would like to avoid, of course, and I am avoiding it very clearly by diversifying in this way. So that's sometimes a bit of a sacrifice in the returns, but on the other hand, it offers a good protection when the markets don't go up, at least for the tech stocks. So what went well in 2024? Well, overall, I had good US exposure, and as many of you probably know, the US markets went very well. I owned 6 out of 7 of the Magnificent Seven stocks, and if I had had only those stocks, then I would have made about 45%. So big tech did very well in this period, and it was good that I had such a large portion of big tech in my portfolio and also of the Mag 7 stocks. I also, in general, had strong tech exposure beyond the big tech stocks, and this also performed well. And some of my hedges performed well, which is I had exposure to gold, which was like a bit more than 25%, and also Bitcoin, which was 150% during this period. So these are all things that went well in 2024. And what went less well is that some of the value investments that I made, like which was the blue part of my portfolio, did perform less well. Some of them performed well, some less well, especially shipping stocks, which I had quite some exposure to, and some energy stocks underperformed the market clearly and had like returns of around 0%. So some of these companies drew down the overall returns of the portfolio. And also the GLP-1 drug companies, Eli Lilly and Novo, had a rough second half of 2024. And even though I believe these companies long term, there will be periods, and there are periods where even great companies perform less well. And this is what happened in the second half of 2024. So the first half of 2024 was just fantastic, and the second half was less good for the portfolio. So in this sense, I suffered a little bit from this diversification that I made, and this made me think that I had to rethink a bit my methodology for choosing the value stocks. So what I've been changing going into 2025 is that I changed my value investing methodology to focus on stocks that don't only have value, but also momentum and other elements. So it's not only value plays, it's something that stocks that have more than one factor in play. So momentum is also going to be a factor even in the value stocks. And after a thorough analysis, I've been cutting some losses to clear the portfolio for 2025, and I've had a strong start to 2025. So I think it seems to be the right thing that I've been doing. I've been focusing the portfolio a little bit, but still I want to have this diversification going forward because the market are almost at all-time highs, and I think we have a good year ahead. But you also need or always need to take into consideration what happens if you're not right about your thoughts about the market. You need to have a second plan and also a defensive plan. So we need to have defensive elements in the portfolio. And for this reason, I still have the diversification, but it's based on a slightly different methodology that I think will perform better in 2025. So I'm going to continue to have a very strong focus on AI and even a stronger focus than I had in 2024. I believe AI is changing the world, and I've added to my AI investments going into 2025. And I'm going to speak about that for some more detail in the later in this update. So overall, I believe that AI is still the main driver of markets in 2025. And I want to give some examples of the work that I've been doing myself. I'm using AI in a lot of different ways. And one of the things I've been doing, of course, I'm doing it to get like a draft for content creation. I'm doing it to analyze data. And recently I've been doing a lot of work in programming. And I used to do some web programming when I was a bit younger. I also took some exams doing that. But I've been doing a lot of work in Python lately, even though I'm not a Python programmer, and that I think is a quite interesting tendency that I think we will see going forward. So I think with generative AI, we can all be programmers. And actually, I've been doing a lot of work in Python without being a Python programmer, and you can see some of the work that I'm doing here, which is focused on predicting stock prices based on a very specific methodology that I'm going to speak more about probably later if I manage to get this to work. So the thing I'm doing is with some certainty to try to predict the stock prices of tomorrow and the day after tomorrow and 3 days from now. So it's short-term prediction, and I'm working with some models that show quite interesting results. And that's even without being a programmer. So I think that what I want to say with this is that I think with generative AI, we can all be programmers. We can all do a lot of stuff that we didn't usually do. And I think like I'm probably part of the first wave experimenting with this, but I think it's something that a lot of people are going to be experimenting with as soon as they find out that these tools can actually do a lot of things and do a lot of, you can actually program small games. You can do a lot of things out of the box from just using ChatGPT. Here I'm using a tool called Cursor for programming, and it's based on Claude, which is the language model of Anthropic, and I think it's even better for coding. So, and doing this project, I've been working with Google Colab as well, and using NVIDIA GPUs, and I think this actually tells me a bit about how people are going to work with this, and what companies' services are going to be in demand in the future. So. I made this short overview of what's in my portfolio and how it relates to AI. And I think that there are three levels of AI investments at this point. First of all, obviously, the hardware investments, which would be like NVIDIA, TSMC, Broadcom, and so on. You have quite a few of those companies in my portfolio. And then you have the model and cloud providers, which we are seeing increasing demand, like Alphabet, Microsoft, Amazon, especially Baidu to some extent, and Meta. They have the models, but no cloud, but the cloud providers is seeing very high demand from people wanting to experience or experiment with large language models. And I think this is just taking off right now because these models can do much more than most people understand at this point. And then there's the third level, which is the level that I'm starting to invest in now, and which we're starting to see the first effects of. And I think those are the companies that are going to build applications on top of the two other layers. And those companies would be companies like Salesforce, Airbnb, even Apple with a new operating system. They're going to use generative AI in their operating system. And I think it may take some more time for this to actually play out, but at some point, this is going to make your smartphone much smarter. And it's at some point down the line, maybe a few years down the line, going to boost Apple sales, I think, because your smartphone is going to be much more useful than it is now. Uh, Unfortunately, a lot of the things that's happening in the applications layer is currently private companies, and those are companies like the ones I've been mentioning here: OpenAI, Perplexity, Anthropic, Grok, Cursor, and so on. And those are companies where I think that they're going to build, and they are building wonderful applications on top of the language models, and on top of and based on NVIDIA's hardware and also the other companies' hardware. So I think the applications layer is the next wave of companies that you would invest in, and that's something that I'm going to keep on looking more into in 2025. We're going to see companies perform much better based on this. So that's quite interesting. And maybe a fourth category would be traditional companies that are just using AI services and AI applications to improve what they're already doing to be more efficient. And this could be anything from companies that have large customer service organizations. You could have lawyers, you could have accountants, and so on, journalists even, and marketing people. All of those people are going to be using AI and are already to some extent using AI today to improve their work. So I think this is certainly a trend that we shouldn't be in doubt about, that this is going to shape the future. I think sometimes people can get a little bit in doubt. Also, when I speak to people and discuss with them on eToro, I can see that if some of these companies perform less well in a period, like let's say over the last six months, then you get in doubt, like, is AI really going to be so, mind-blowing? Is it going to change everything as I'm expecting it to do in the next 5 to 10 years? And I think it's important to just view the long-term perspective of this, that even if a stock performs not so well for 6 months or even 1 year or more, then you need to hold to your beliefs. And my clear belief is that these companies are shaping the world of tomorrow. And I'm going to continue to find those companies, especially in the application layer, that are going to revolutionize the world with AI applications. So one concern that I think that's very interesting to discuss and very important to discuss is that if the market is valued too high at this point, and especially the big six tech companies, which are the ones I've been listing here: Apple, Microsoft, Amazon, Meta, Google, NVIDIA. They have increased a lot when it comes to returns in 2024. And I think it's natural to ask the question, like, first of all, some people speak about, is it a bubble, or did they rise too much in 2024? And I just want to compare them to the rest of the market, because if you look at the price, yeah, it's correct that in 2024, these companies performed much better than the overall market. And they were part of my portfolio. All of those companies, I have those companies, I think between 3 and 6% positions of each of those companies. And they had returns of 47% in 2024. And the rest of the market, the SP 500 without the big six, had returns of 14%. If you look at the PE, then you will see that they had a slight multiple expansion of 5.8%, but the rest of the market actually had a larger expansion of 8.6%. So this means that the multiple expansion of the rest of the market was actually higher than the S&P 500. So they had a high PE value, but the rest of the market had a larger expansion of the PE. And why do they have a large PE value? If you look at this very simple metric, then the simple explanation is that if you look at the EPS, the earnings per share in 2025 over this year, it rose 38.9% on average for the big six tech companies, and 5% for the rest of the companies, the 494 companies. So this means that they just earned much more per share. Their earnings grew much more than the rest of the market. So for this reason, it's very much deserved that those companies have stock prices that are rising more. And if you look at next year, you will see that they had a large EPS growth in 2024. In 2025, they're also expected to have a larger EPS growth, but the rest of the market is somewhat catching up, but they're still expected to overperform and have almost twice as high EPS as the rest of the market. So for this reason, my clear conclusion is that when you look at this, the most important thing for the market is that the profit growth is what is valued highly by the market, and less about the absolute valuation, at least in the short term, which is like the 12-month horizon. So in 2024, the big six earnings have steadily been revising the EPS, while the remainder of the market has been drifting relatively lower. And this is something we can expect to continue in 2025. And for this reason, these companies are still a very important part of my portfolio, even though I don't want to be overexposed to them. I think it's important to have quite a fair portion of these companies in my portfolio. So overall, I think it's worth looking at the 90s, because now we had two very good years in the S&P. I think we had like growth of more than 50%, like 25% on average in the last 2 years. So we had a growth of more than 50% in 2 years, and then you would expect maybe the markets to have some kind of correction in the year after that, and that's certainly very much possible that 2025 is not as good a year as the other years. But on the other hand, like one period that has some similarities to this period that we're in is the 90s. So, and what we had during this period is from 1995, we had returns of double digits, like 20% or more for 5 years in a row, which is quite extraordinary. Obviously, we know that this didn't turn out well in the year 2000, when we had the bubble that burst. But up until that point, we had a long period of very, very good returns. And this was riding on the back of the internet, which it was being made public in 1993. And after this, there was a lot of interest and obviously a lot of optimism in the market. And I think this optimism is more or less the same that we're experiencing now, only now that the fundamentals are much more in place, that the companies that are leading the revolution are actually earning a lot of money. They have a very strong EPS growth. So for this reason, I think it's like the 90s, but without the bad part of the 90s, which was that some of the companies that people invested in didn't really have good profits. So it's certainly possible that you can have more than 2 years in a row with very good returns. But my overall expectation would be that we have a positive year, that we gain about 10% in the S&P, which would take us to around 6,600 in the S&P. And that's just a rough estimate of where we could go, based on the information that we have right now. And I'm going to speak about how this could turn out differently, but that is my main main prediction at this point. So one thing to take into consideration is that when valuations are higher than they have been historically, when you look at the price to earnings metric, then it doesn't actually tell you something about what the returns will be in 1 year from now. So you can have high valuations like you had in the 19s, and you can have very good years year after year, even with high PE values. So in this graph, the brown dots, orange/brown dots, they represent the 1 year returns. So if you look at the x-axis, you have the price earnings ratio, and you will see that the further you go out on this axis, you will have 1 year returns that are still much below zero and much above zero. So this tells you that there's no really clear correlation between high PE values, high valuations, and forward returns when it comes to 1 year. But when you look at the 10-year annualized returns, then this shows you, this regression line shows you that if you are at the higher end of this area, that the 10-year returns could be expected to be less than average. So we have also been seeing this in forecasts from Goldman Sachs. So they're saying they're expecting a good year this year, but on the 10-year horizon, they don't expect like a better than average. They actually expect worse than average returns. But obviously, this doesn't mean that we should jump out of the stock market, because on the 1 year horizon, there's really no correlation with valuations with regards to returns. But there's certainly in the more long term, it's worth thinking about that if valuations stay this high, then it can at some point affect the long-term returns. So that's going to be interesting to follow in the following years. But for 2025, I'm still quite optimistic, cautiously optimistic, of course, because there are a lot of things that can go wrong. And I'm going to come back to that later to say now I have a bullish view, but what can change this bullish view? That's quite important to look into. And I'm going to speak a little bit about the current markets before I jump on to the next step. So for the last month, that has been a rough patch for the market. The last part of December was not very good, and we're seeing only very few companies having positive returns over this period. Luckily, two of those companies were some of the ones I had in my portfolio, which is obviously Google and AVGO, which is Broadcom, which is another company that I have in my portfolio. But a lot of other companies had mediocre returns, like Nvidia almost zero, Apple almost zero, Amazon, Microsoft, Meta slightly negative. So it has been a rough period, but looking on a 3 year horizon, the picture is a bit better. And we're seeing that especially the big tech companies performing well during the last part of 2024. Now also financials performing well, credit services performing well, asset management performing well, and capital markets companies like Goldman Sachs, Morgan Stanley performing well, and entertainment software performing quite well, and other areas of the market performing less well. Healthcare is one example of something performing not so well. Basic materials also in the red. So this tells you that the momentum is back on the side of big tech, of tech in general, of the financial sector, and also on software companies and entertainment. And what we've been seeing is during this period that we had, of course, a huge euphoria from the markets after Trump was elected. And now we're seeing this being dialed back a bit. So we are almost back to the levels where we started in the beginning of November when Trump was elected for president. So we're seeing kind of, buy the rumor, sell the news. So I'm expected market to be a little bit like sideways for the next period. And then over the year, I have positive expectations for where we will develop. But certainly, there's going to be a lot of uncertainty with Trump coming into office. And I think the markets were originally quite positive about it, but now probably many investors are thinking that there's some kind of uncertainty connected to what he's going to do and what kind of policies uh, he's going to start. So in this sense, I think the market's probably a little bit nervous. And we've also been seeing that while inflation came down in 2023, we have made kind of not much progress in most of 2024, actually seeing the core PCE going up slightly. So the inflation fight is still very much on, and that's something that has probably spooked at least the bond markets a bit because they don't believe in so many rate cuts from here as they expected last year. So for now, it looks like we're going to have one or two rate cuts for this year, and that's certainly less than we expected just 1 month ago. But after Chairman Powell had his speech in December, then markets adjusted into this, and now markets are expecting only one or two rate cuts for this year. And over time, this is the so-called dot plot, which shows what the policymakers think how the interest rate is going to develop over the next years. And most of them are expecting the Fed funds rate to go down, but quite slowly compared to what we were expecting earlier. So interest rates are probably going down, but at a much slower pace than what we hoped for. But this is probably still okay for markets because the economy is strong. And recession fears, on the other hand, has been declining, and Goldman Sachs is now back at 15% chance of recession within the next 12 months. And this is lower than the Bloomberg consensus, but for sure, recession fears in the US are declining in 2024. So I think at this point, inflation is actually a higher worry. It's more worrying for the markets than recession at this point. So that's what the most investors and analysts are focusing on at this point. So at this point, it seems like we may have a so-called no landing scenario because the US economy is resilient. Inflation may remain at this level, more or less where it is now. And markets are pricing only one or two rate cuts in 2025. One thing to watch out for is what the bond market is telling us. We're seeing the 10-year Treasury yield rising again close to 4.7%. And if this rises close to 5%, it's going to be probably negative for stocks because this is kind of the pain level, which is acceptable for the stock market, it seems. And it's telling us that the US economy remains remaining strong, but inflation fears remain. And also, there's some uncertainty surrounding Trump's immigration and trade policies. So at this point, that's something to watch out for. If the 10-year Treasury yield keeps on rising, then it's certainly something that could be a negative for stock markets. So that's something that I'm following too. So yeah, what happens for the rest of the years? I think the most likely scenario is a slightly bullish scenario. I think expectations are quite high for the companies at this point. So this means that if companies, especially big tech, don't live up to their expectations, then you can see some drops in stock prices, which means that we may see more volatility because the market is priced almost for perfection. So there's not allowed. You cannot allow for many mistakes or any kind of underperformance for the leading companies. So for this reason, I think we could see some more volatility this year. I expect that inflation will remain under control and the Fed will cut interest rates only very one or two times, and that we avoid a recession. So the overall picture is that we most likely will see a positive year, a year where the markets end 2025 at a higher place than where we are now. And for this reason, I think that it's certainly worth being invested in the stock market, but you also want to have diversification. This could be in the form of US dollars, it could be gold, it could be Bitcoin. I have all of those three hedges in my portfolio, so I think it's important to not only be in 100% in US stocks at this point, you want to diversify somewhat. So I think that's important. So so even if I have a bullish view on the market, a slightly bullish view at this point, I think there's certainly uncertainty surrounding Trump's policies. I think we could see a sell the fact, like buy the rumor, sell the fact situation where when Trump gets in office, so markets may correct, and there can be some uncertainty around his policies, which also could lead to markets correcting. We have geopolitical unrest, for instance, in Ukraine. We have slightly rising inflation, and also this could escalate. So if we have more rising inflation, we could see fewer rate cuts, even no rate cuts this year. So that's certainly a risk that we should be focusing on. So I think these are the main risks, and these can disturb the bullish view or the bullish scenario that I'm having this year. So these are the factors that I'm following, and I have actually set a plan in place to find out if there are more uncertain times coming, which and if this leads to a correction, how am I going to redistribute the portfolio? How am I going to change the portfolio? And I'm working on this right now. But overall, my view on the markets is positive at this point. So the last thing I want to say is that I think, or I would urge you to make investing a habit like I've been doing. I think it's advisable to take a little bit out of your paycheck every month and invest it in the market. If you have a long-term horizon, you can just invest it in the stock market like I do. I have a very long-term horizon myself. I have 14 years at least on a Toro to make this portfolio grow to $1 million. And I think it's important to just do it, to make it a habit, to put a little bit aside every month, because you are not going to miss the money so much in this moment, and later you're going to have a compound interest of this money growing while you're sleeping. So I think it's probably the easiest way to grow your fortune, and for this reason, I advise everyone to make this a part of your everyday life. So that's all for now. I just want to say to you that you are welcome to ask me questions in the comments box when I post this on eToro or on YouTube. You're welcome to ask me questions, and I will get back to you as soon as possible. As soon as I see the questions, I'll try to answer them as well as I can. So thank you very much for listening to my first quarter update here. I'll see you soon.